Tom Lee from Fundstrat just made a bold prediction about the stock market, saying a massive rally could still be ahead as the AI boom continues gaining momentum. After Nvidia's latest earnings report showed what he called unrelenting demand for AI infrastructure, Tom Lee explained why he believes this market still has more upside despite rising oil prices, higher yields, and growing economic concerns. In this video, I'm going to show you the clip from CNBC featuring Tom Lee's full comments, then I'll break down exactly what he meant, what I agree with, what I think investors should be cautious about, and why this could have major implications for AI stocks and the broader market moving forward. And after that, I'll give you my deep dive on two of the best tech stocks to buy on the dip right now as this AI-driven market continues to evolve. Let's hear what Tom Lee had to say.
Now that Nvidia earnings are out of the way, is the AI trade about to take its next leg higher? Let's ask Tom Lee. He's Fundstrat's head of research. Welcome back. So how do you assess this now? We've cleared the way, right? All the AI stuff's now out of the way. We're looking at yields, we're looking at oil, we're looking at the Middle East, but how do you feel about this market when you just heard Chris Harvey at the top of our show saying we're going to have an everything rally that's going to take us past 8,000 by the end of the year?
Yeah, Scott, I think the market is pretty healthy. It showed resilience in the face of higher oil, higher yields. But I also think the U.S. is pretty unique because we do have a structural driver for the economy, which is not only is the U.S. the producer of AI, but we are also relatively energy independent, and that's been exposed by this war. And the consumer's in pretty good shape. So, I mean, I think there is a pretty good runway. So I'd agree with the idea that stocks, compared to the start of this year, have more upside into year end. We've got a few things we have to work through as we get later through the year, but I think for now the fundamentals are healthy, and that's supported by earnings.
I don't know what shape the consumer's in, to be honest with you. I mean, I understand the K-shaped economy, obviously. Top of the K is better than the bottom of the K in terms of the durability to keep spending. But you listen to Walmart, which was pretty cautious, and you're like, what is the real state of the consumer? And if oil prices remain elevated for too long, is that the thing that wrecks the story?
Scott, yeah, it is, in a way it is K-shaped, because if I had to say, okay, what are the things that are sort of ballast and things moving the consumer? Of course, we know that it's higher gasoline, higher food, and of course there's going to be a shortage of some petroleum products. But on the other end of that spectrum is, the wealth that's going to be created by the IPO, SpaceX, OpenAI, et cetera. I mean, that's several $1 trillion worth. And as we know, there's like a marginal propensity to consume from the wealth effect. So I think the consumer's getting a tailwind later this year, but a lot of it is for those who own equity.
I mean, a tailwind from owning the IPOs?
Well, it's actually the private investors. As we know, SpaceX was probably seeded at $50 million. It probably raised tens of billions over the last decade. But now it's going to have a net worth valuation of around $1.7 trillion. So that's actually now going to be monetized for the LPs of the funds that invested in SpaceX. So they're, several $1 trillion is quite a lot of stimulus to the economy.
Wow. Okay. Hampton's real estate market. Watch out. AI trade. How do you feel about it after Nvidia?
I mean, a company with the size of revenues, Nvidia, growing at 8%, I think shows that there is still, unrelenting demand for the product Nvidia sells. And then we know that those who are starting to use AI are actually noticing a gain of function on productivity. Ken Griffin really stated it well when he says he could see it's replacing a lot of analysts. So to me, I think not only are the users of AI benefiting, but there's still a shortage of those who are supplying the equipment.
But aren't you still calling for a pullback in stocks and something meaningful? Like the one we had already didn't really qualify, if you will, under what you were thinking could happen, right?
That's right, Scott. I think we had like what Ed Yardeni would call a rolling bear market in things like Mag 7, and of course last year in energy, but in software, et cetera. But I think later this year, the market is going to confront a few things. One, of course, is just your typical midterm seasonality, the uncertainty into that. The second is that there is a day of reckoning coming because the inventory of petroleum products is short and not being alleviated anytime soon. And the third is we probably have some concerns later as these IPOs come, SpaceX, OpenAI, et cetera, that there's a lockup expiration later. So I think that's a supply overhang. So I think that dynamic comes to play later this year. But in the meantime, I think investors are focusing on AI fundamentals, and there's a real shortage, and stocks that are working are the ones that are selling something that's scarce.
Tom, I want to make sure I heard you right. Are you calling for a rolling bear market in Mag 7 names? Because is that what you're looking for? You look for these stocks to become weaker at some point, and dramatically so at some point this year? Is that what I heard you say?
To clarify, I think we've already had a bear market in Mag 7 and software. I think there's going to be a bear market in other stocks later this year, yes. But I think it's going to spare the Mag 7 and software, so it's going to be names that either got lofty or are going to be affected by the fact that there is a lot of supply of new stock later this year, or the companies that are going to get hit by the shortage in petroleum products. So I think there's reasons that we could have headwinds later this year.
Are you talking about like semiconductor stocks?
Yeah, semis may become a bubble. To me, they don't seem like a bubble yet. When Nvidia is trading at 19 times earnings, I think it's still a good risk reward. But I think that there are parts of that ecosystem that have become quite expensive.
In this interview, Tom Lee laid out a surprisingly bullish case for why he believes the market still has room to run, even with oil prices climbing, bond yields staying elevated, and geopolitical tensions heating up around the world. But at the same time, he also warned that there are cracks underneath the surface that investors should not ignore. And honestly, this is what makes Tom Lee so interesting to listen to. He is not somebody who usually operates from fear. Even when markets pull back, he tends to look at the bigger structural trends instead of reacting emotionally to short-term headlines. In this interview, you can really hear that balance between optimism and caution. He believes the AI boom is very real, but he also thinks investors may be underestimating some major risks later this year. Right from the beginning of the conversation, Tom Lee says the market has shown resilience. That is really the key word here: resilience. Stocks have managed to hold up despite higher oil prices, rising treasury yields, and concerns about instability in the Middle East. Normally, when those three things happen together, investors start panicking. Yet the market continues grinding higher. Tom Lee believes that says something important about the underlying strength of the U.S. economy. He points to two major structural advantages the United States currently has. First, America is leading the AI revolution. Second, the country is relatively energy independent compared to many other parts of the world. That combination matters more than people realize. AI is becoming the new industrial revolution, and the companies building the infrastructure for it are mostly American companies. Nvidia, Microsoft, Amazon, Meta, Google, and all these hyperscalers are spending billions building AI capacity. According to Tom Lee, that creates a long runway for growth. Personally, I think this is one of the strongest bullish arguments for the market right now. If AI truly transforms productivity the way many experts believe it will, then we may still be early in this cycle. A lot of people compare this moment to the early internet boom, but the difference is these AI companies are already generating enormous cash flow. Nvidia is not some speculative startup burning money. It is one of the most profitable businesses in the world. That changes the equation. Tom Lee also argues that the consumer is still in decent shape, although the interviewer pushes back pretty hard on that idea. And honestly, I think the interviewer raised fair concerns. We keep hearing about a so-called K-shaped economy, where wealthy consumers continue spending while lower-income consumers are struggling under inflation, rent costs, food prices, and debt payments. You can see it in retail earnings. Some companies are thriving while others are warning about weaker spending patterns. The interviewer specifically brings up Walmart sounding cautious about consumers and asks whether high oil prices could eventually break the entire bullish narrative. Because at the end of the day, energy costs impact everything. Higher gasoline prices reduce disposable income. Higher transportation costs increase inflation pressures. And if oil spikes too far, it eventually hits corporate margins and consumer spending simultaneously. Tom Lee responds by acknowledging that reality, but then pivots into what might be the most fascinating part of the interview. He believes there is another force coming that could offset those pressures, and that is the massive wealth creation from AI companies and upcoming IPOs. He starts talking about companies like OpenAI and SpaceX potentially creating trillions of dollars in new wealth once those valuations become fully monetized through public markets or liquidity events. His argument is that this new wealth effect could stimulate spending in the economy. Investors, venture capital firms, and private equity players who backed these companies early could suddenly see enormous gains, and some of that money eventually flows back into the economy through consumption and investment. Now, this is where I think the conversation becomes both exciting and controversial. Because while I understand his logic, this wealth effect mainly benefits people who already own assets. The average person struggling with grocery bills is probably not going to feel rich because OpenAI's valuation increases. So, while AI wealth creation could absolutely fuel luxury spending, real estate markets, and financial markets, I am not fully convinced it solves the broader consumer problem for everyone. But from a market perspective, Tom Lee may still be right. Markets are driven heavily by liquidity and capital flows. If trillions of dollars of paper wealth are created in AI-related sectors, that can absolutely keep stocks elevated longer than many bears expect. Then the discussion shifts directly into Nvidia and the broader AI trade. Tom Lee says Nvidia's incredible growth proves that demand for AI infrastructure remains relentless. That word again stands out, relentless. According to him, businesses adopting AI are already seeing real productivity improvements, which validates the massive spending taking place. He even references billionaire investor Ken Griffin saying AI could replace many analysts. And whether people like hearing that or not, it highlights how transformative this technology could become. We are already seeing AI automate coding, writing, customer support, data analysis, and research tasks. Companies are investing aggressively because they do not want to be left behind. Personally, I think investors should pay attention to this part very carefully. During many past bubbles, there was eventually a disconnect between hype and actual utility. But AI already has real-world use cases today. Businesses are actively integrating these systems into operations right now. That does not mean every AI stock is fairly valued, but it does mean the technology itself is not just a fantasy story. Tom Lee also points out something important about scarcity. He says the stocks performing best right now are companies selling something scarce. That is a huge insight. In AI, there is currently a shortage of the chips, infrastructure, data centers, and computing power needed to support demand. Nvidia benefits because it is supplying the picks and shovels for the gold rush. And honestly, this reminds me a lot of historical economic booms where infrastructure providers often became some of the biggest winners. During the internet era, companies building the networks and hardware infrastructure became essential. In the AI era, Nvidia and semiconductor companies are playing a similar role. But then the interview takes a more cautious turn. The interviewer reminds Tom Lee that he previously warned about a meaningful market pullback later in the year, and this is where his outlook becomes more nuanced. He explains that while the market is healthy now, there are several potential headwinds approaching. First, he mentions seasonal political uncertainty related to the midterm cycle. Markets tend to dislike uncertainty, especially around elections and policy changes. Second, he warns about petroleum shortages becoming a bigger issue later in the year. This is something many investors may not be paying enough attention to. If energy inventories tighten further while geopolitical tensions remain elevated, oil prices could rise sharply and eventually pressure both consumers and corporations. And third, he warns about the flood of new stock supply that could hit the market once these giant AI companies eventually go public or see lockup expirations. That is a really interesting point. When insiders and early investors finally gain the ability to sell shares after IPO lockups expire, it can create selling pressure and shift market dynamics. So even though Tom Lee remains bullish near term, he clearly believes the second half of the year could become much more volatile. The interviewer then asks him directly whether he expects a rolling bear market in the Magnificent Seven stocks. Tom Lee clarifies that he actually thinks those mega-cap technology names may hold up better than many other sectors. According to him, the bigger risks may hit companies outside the AI leaders, especially businesses exposed to energy shortages or companies that became overly inflated without strong fundamentals. That distinction is extremely important. Not all parts of the market are equal right now. AI leaders with dominant positions and massive earnings growth are fundamentally different from speculative companies riding the hype wave without real profitability. Then Tom Lee says something that really caught my attention. He admits semiconductor stocks may eventually become a bubble, but he does not think they are there yet. That is probably the biggest debate happening on Wall Street right now. Are semiconductor stocks in a bubble, or are they simply repricing to reflect a new technological era? Personally, I think there is truth on both sides. Some valuations have clearly become stretched, but if AI spending continues growing exponentially over the next several years, then current earnings estimates may still end up being too low. This is why timing the top of these kinds of trends becomes extremely difficult. During transformational technological shifts, valuations often look expensive for years before the underlying earnings eventually catch up. We saw that happen with companies like Amazon during the internet era. Overall, the biggest takeaway from this interview is that Tom Lee still believes the AI-driven bull market has more room to run, at least for now. He sees strong fundamentals, enormous demand for AI infrastructure, resilient earnings growth, and a powerful structural advantage for the U.S. economy. But at the same time, he is warning investors not to become blindly euphoric because oil shocks, political uncertainty, and liquidity events later this year could create serious volatility beneath the surface. And honestly, I think that balanced perspective is probably the smartest approach right now. There is clearly massive opportunity in AI, but there is also growing speculation and crowd psychology entering the market. Investors who completely ignore the risks could get blindsided if conditions suddenly change. Now let's dive in and talk about the two elite tech stocks that could become some of the biggest long-term winners to buy during this market dip before Wall Street fully catches on. The first stock on this list is Salesforce, ticker symbol CRM. When most people think about tech companies, they immediately think about flashy AI startups, semiconductors, or consumer apps. But Salesforce operates in a different category entirely. This is the digital infrastructure layer that thousands of businesses rely on every single day to manage customer relationships, sales pipelines, marketing campaigns, analytics, and now increasingly, artificial intelligence-driven workflows. That matters because enterprise software tends to be incredibly sticky. Once a company builds its operations around a platform like Salesforce, switching becomes extremely difficult, expensive, and disruptive. Employees need retraining, data migration becomes risky, entire workflows must be rebuilt. That creates one of the strongest business moats in the entire technology sector. And despite being one of the most established enterprise software companies in the world, Salesforce still appears to have significant upside potential according to several Wall Street analysts who believe the stock remains undervalued after its recent pullback. What makes Salesforce especially interesting right now is that the market seems conflicted about the company. On one hand, investors know Salesforce is dominant in customer relationship management software. On the other hand, there are concerns about slowing enterprise spending and whether the company can sustain strong growth at its massive size. But this is where long-term investors need to separate short-term noise from long-term business quality. Salesforce is not just another software company trying to survive the AI revolution. It is positioning itself to become one of the biggest enterprise AI beneficiaries in the world. The company has already integrated AI deeply into its platform through products like Einstein AI, allowing businesses to automate customer support, improve sales forecasting, personalize marketing, and analyze huge amounts of enterprise data faster than humans ever could. And here is what makes this powerful. Salesforce already has access to enormous amounts of customer data through the businesses using its ecosystem. In the AI era, data becomes one of the most valuable assets any company can possess. The more data you have, the smarter your AI tools become. That gives Salesforce a competitive advantage that newer companies cannot easily replicate. Think about how valuable that is over the next decade. Businesses are going to need AI-powered tools to improve efficiency, reduce labor costs, and increase productivity. Salesforce already sits directly in the middle of those workflows. Instead of companies replacing Salesforce because of AI could actually strengthen Salesforce's importance. This is one reason why many investors believe the market may be underestimating the company's long-term potential. Financially, Salesforce remains an absolute machine. The company continues generating billions in annual revenue while also improving profitability and free cash flow. Revenue recently crossed the $30 billion range annually, showing just how enormous the business has become. More importantly, management has become much more disciplined with expenses, which investors have rewarded. That shift toward profitability matters because for years, critics argued Salesforce focused too heavily on growth at the expense of margins. But now the company is showing it can do both. It can continue growing while also becoming more efficient and shareholder-friendly. Salesforce has also aggressively repurchased shares, which is important for long-term investors because buybacks reduce share count and increase the value of remaining shares over time. Companies generating enough cash to both invest in growth and return capital to shareholders tend to perform very well across long periods. Another thing investors should not overlook is how deeply Salesforce is embedded into enterprise digital transformation. Businesses across industries are still moving more operations into cloud-based systems. Sales teams, customer service departments, marketing operations, analytics divisions, and commerce platforms all increasingly depend on integrated cloud ecosystems. And once businesses adopt Salesforce products across multiple departments, the relationship becomes even stronger. This is what creates ecosystem lock-in. A company may initially adopt Salesforce for sales management, then later add marketing tools, customer service solutions, AI integrations, and analytics platforms. Over time, Salesforce becomes deeply woven into the company's operations. That ecosystem effect is incredibly difficult for competitors to disrupt. Now, one concern investors often bring up is valuation. Even after the pullback, some people still believe Salesforce trades at a premium compared to slower growth companies. But premium businesses often deserve premium valuations. The key question is whether the business can continue compounding earnings and cash flow over time. And honestly, I think the market sometimes underestimates how important enterprise software becomes during economic uncertainty. When businesses are pressured to operate more efficiently, they often invest more into productivity software, automation, analytics, and AI tools that can help employees perform better. That actually creates a strong long-term setup for companies like Salesforce. Another thing I personally like about Salesforce is management's growing focus on operational discipline. Investors have become far more selective in this market environment. They no longer reward growth at all costs. Companies now need to prove they can generate sustainable profits and real cash flow. Salesforce appears to understand that shift. At the same time, the company still has multiple growth levers ahead. AI integration is one, international expansion is another. Cross-selling additional products into existing customers is another major opportunity because Salesforce already has relationships with so many enterprises around the world. And remember, customer relationship management software is not becoming less important. If anything, businesses are becoming even more dependent on customer data, personalization, analytics, and automation. Salesforce sits directly at the center of all of that. One of the most underrated strengths of Salesforce is that it benefits from recurring revenue. Subscription-based software models create predictable cash flow because customers continue paying monthly or annually for services they rely on daily. Investors love predictable recurring revenue because it creates financial stability even during uncertain economic periods. This is one reason why enterprise software companies often command strong long-term valuations. Predictability matters. Now let's talk about the AI angle again because I think this is where many investors may still be underestimating Salesforce. Everybody focuses on flashy AI chatbots and consumer tools, but enterprise AI could ultimately become even more valuable because businesses are willing to spend huge amounts of money if AI improves productivity and profitability. Salesforce has the infrastructure, the data, the enterprise relationships, and the distribution network to capitalize on that shift. The company does not need to win the consumer AI race. It simply needs to become more valuable to enterprise customers, and early signs suggest that is exactly what is happening. Another important point is that Salesforce operates in a market with enormous total addressable opportunity. Businesses everywhere are still modernizing operations. Many companies still operate with outdated systems, fragmented customer data, or inefficient workflows. Digital transformation is not finished. It is still happening globally. That gives Salesforce a very long runway for growth even at its current size. Now, does that mean the stock will only move upward from here? Of course not. Stocks always experience volatility. Enterprise spending can slow during economic weakness. Investors can rotate out of software names temporarily. Market sentiment can change quickly, but long-term investing is about identifying businesses that can continue compounding value through multiple economic cycles. And Salesforce looks like one of those businesses. Personally, I think one of the biggest mistakes investors make is waiting for perfect conditions before buying quality companies. By the time everything feels safe again, many of the best opportunities are already gone. Historically, some of the strongest long-term returns came from buying elite companies during periods of uncertainty, pessimism, or temporary pullbacks. That is why this dip in Salesforce has become so interesting. The company still dominates customer relationship management software. It still generates enormous recurring revenue. It still produces strong cash flow, it is still integrating AI aggressively, and it still benefits from powerful ecosystem effects that make switching difficult for customers. Those are the kinds of characteristics long-term investors should pay attention to. And if AI-driven enterprise productivity becomes one of the biggest investment themes of the next decade, Salesforce could quietly become one of the biggest winners hiding in plain sight. Because at the end of the day, the future of business is not just about creating AI. It is about integrating AI into real-world operations that companies depend on every single day. Salesforce already has a front-row seat to that transformation. And sometimes the best investments are not the loudest companies in the room. Sometimes they are the businesses already deeply embedded into the global economy while quietly compounding year after year. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on this list is Intuitive Surgical, ticker ISRG. And honestly, this may be one of the most quietly dominant companies in the entire market. While everybody is distracted chasing the latest AI headline or semiconductor rally, Intuitive Surgical has spent years building one of the strongest competitive moats in healthcare technology. This is not a company relying on hype, social media excitement, or speculative promises about the future. This is a business already transforming how surgeries are performed around the world right now. That distinction matters, because when you are looking for long-term compounders, one of the most important things to ask is whether the company provides something that customers truly depend on. In Intuitive Surgical's case, hospitals and surgeons are increasingly depending on robotic-assisted surgery systems because they can improve precision, reduce complications, shorten recovery times, and help patients leave hospitals faster. And once a hospital invests in Intuitive Surgical's ecosystem, switching becomes extremely difficult. This is where the company's moat becomes incredibly powerful. Intuitive Surgical is best known for its Vinci robotic surgery systems. These machines are not simple devices hospitals casually replace every few years. They become deeply integrated into surgical workflows, surgeon training, hospital infrastructure, and patient care systems. Surgeons spend years mastering these systems. Hospitals invest heavily into training programs, operating room integration, maintenance contracts, and procedure expansion. That creates an ecosystem effect very similar to what we see in elite software companies. The more hospitals use the system, the more surgeons become trained on it. The more surgeons become trained on it, the more hospitals want the system. That creates a self-reinforcing cycle that becomes harder for competitors to disrupt over time. And this is exactly why Intuitive Surgical has maintained such a dominant position in robotic surgery for years. But what makes the company especially attractive right now is that many investors still underestimate how early robotic-assisted surgery may actually be globally. Even though robotic surgeries have grown significantly over the past decade, the majority of surgeries worldwide are still not robot-assisted. That means the long-term runway for adoption could remain enormous. Think about the scale of this opportunity. Every year, millions of surgeries are performed globally across procedures involving urology, gynecology, colorectal operations, thoracic procedures, and many other specialties. As robotic technology improves and hospitals continue modernizing, more of those procedures could eventually shift toward robotic systems. And Intuitive Surgical already has the dominant installed base. This is incredibly important because installed base often creates recurring revenue opportunities that investors overlook. Most people focus on the initial sale of the robotic systems, but the real beauty of the business model is what happens afterward. Every surgery performed using a Vinci system generates recurring revenue through instruments, accessories, service contracts, and maintenance. That means as procedure volumes grow, recurring revenue grows alongside it. This creates a business model that becomes stronger over time. In many ways, Intuitive Surgical operates almost like a razor and blade model. The hospital buys the system, but then continuously purchases the instruments and services needed to keep surgeries running. That recurring revenue dynamic gives the company remarkable financial stability, and the numbers behind the business are incredibly impressive. Intuitive Surgical has continued growing procedure volumes year after year, even during periods of economic uncertainty. Revenue has climbed steadily into the multi-billion-dollar range annually, while the company maintains exceptionally strong margins and a balance sheet loaded with cash. What stands out most to me personally is the quality of the business, not just the growth rate. There are many companies that can temporarily grow revenues quickly, but very few businesses combine market leadership, recurring revenue, global expansion opportunities, strong margins, financial stability, and technological dominance all at the same time. Intuitive Surgical checks almost all those boxes. Another thing investors should understand is that healthcare technology adoption tends to move slowly at first, then accelerate over time once systems become trusted and proven. Hospitals are naturally cautious, surgeons are cautious, regulatory environments are cautious. But once technologies demonstrate consistent success and improved patient outcomes, adoption can compound for years. That is what makes Intuitive Surgical so fascinating as a long-term investment. This is not a business dependent on short-term consumer trends. People do not stop needing surgeries because the economy slows down for a quarter or two. Healthcare demand remains durable over long periods, especially as populations age globally, and aging demographics could become one of the biggest tailwinds for Intuitive Surgical over the next several decades. As populations grow older, the number of surgical procedures performed globally is likely to increase. Healthcare systems will continue looking for ways to improve efficiency, reduce recovery times, and enhance patient outcomes. Robotic-assisted surgery fits directly into those objectives. Now, one concern some investors raise is valuation. Intuitive Surgical has often traded at premium valuations because the market recognizes the quality of the business. And yes, the stock is not necessarily cheap using traditional valuation metrics compared to slower growth companies. But elite businesses rarely look cheap. This is something many investors struggle with psychologically. They wait for amazing companies to trade at extremely low valuations, but truly dominant businesses often maintain premium pricing because institutions understand their long-term compounding potential. That does not mean investors should ignore valuation completely. It simply means quality matters, and Intuitive Surgical's quality is extremely difficult to deny. The company has built years of surgeon trust, hospital relationships, technological expertise, and operational scale that newer competitors cannot easily replicate overnight. Healthcare is not an industry where hospitals casually experiment with unproven technologies for critical procedures. Trust becomes everything. That trust advantage creates a massive barrier to entry. Another thing I personally like about Intuitive Surgical is that the company does not seem obsessed with chasing every trend or making flashy promises. Management has generally remained disciplined and focused on expanding procedure adoption, improving technology, and strengthening the ecosystem gradually over time. That long-term mindset matters. In investing, some of the best compounders are businesses that quietly execute year after year while the market becomes distracted by louder stories elsewhere, and Intuitive Surgical may fit that description perfectly. Now let's talk about AI for a moment, because even though Intuitive Surgical is primarily viewed as a robotic surgery company, artificial intelligence could still play an increasingly important role in its future. AI-assisted analytics, imaging improvements, surgical planning, workflow optimization, and machine learning enhancements could all make robotic surgery systems even more effective over time. Imagine surgical systems that continuously learn from millions of procedures globally, helping improve precision, identify patterns, and optimize surgical techniques. That kind of data advantage could become incredibly valuable. And once again, Intuitive Surgical already has scale, procedure data, surgeon relationships, and installed systems in place. That gives the company a strong foundation moving into the next era of healthcare technology. Another major strength here is international expansion. While Intuitive Surgical already has a strong presence in many markets, robotic surgery adoption globally is still far from saturated. Emerging healthcare systems, improving hospital infrastructure, and rising healthcare spending internationally could all support future growth. That gives the company multiple growth drivers simultaneously. You have recurring procedure growth, you have new system placements, you have international expansion, you have AI and technological enhancements, and you have aging demographics supporting long-term healthcare demand. When you stack all those factors together, it becomes easier to understand why long-term investors remain so bullish on the company despite temporary stock pullbacks. Now, of course, no investment is risk-free. Healthcare regulations can change, competition could eventually intensify, hospital budgets can become pressured during economic downturns, and premium valuation stocks can experience sharp corrections when market sentiment shifts. But when I look at Intuitive Surgical, I see a company operating from a position of strength. This is not a turnaround story hoping things improve. This is not a speculative startup trying to prove its business model. This is an established market leader with years of operational success and enormous long-term potential. And honestly, I think many investors still underestimate how powerful healthcare innovation can become as an investment theme over the next 20 years. Technology is transforming industries everywhere, but healthcare may ultimately become one of the biggest long-term beneficiaries, because improving outcomes while reducing inefficiencies creates enormous economic value. Intuitive Surgical sites directly at the center of that transformation. Personally, I also think there is something psychologically reassuring about investing in companies whose products provide clear real-world value. Hospitals are not buying robotic surgery systems because they are trendy. They are investing because these systems can improve operations, attract skilled surgeons, enhance patient care, and potentially deliver better outcomes. That creates durable demand. And durable demand is exactly what long-term investors should look for, because over long periods, stock prices usually follow business quality. Short-term market sentiment can move prices around unpredictably, but companies that consistently grow revenue, strengthen moats, expand ecosystems, and generate cash flow often reward patient shareholders. That is why this dip in Intuitive Surgical could become such an interesting opportunity for long-term investors focused on quality. The company continues expanding globally, procedure volumes continue growing, hospitals continue adopting robotic systems, recurring revenue continues increasing, and the broader healthcare technology trend still appears to be in its early stages. Those are powerful ingredients for long-term compounding. And if robotic-assisted surgery eventually becomes the global standard across more procedures over the next decade, Intuitive Surgical could remain one of the biggest winners in modern healthcare technology. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.